Good day, my name is Dean Crocker. I'm a senior equity analyst for the PSG Wealth research team, and today I'll be taking you through our latest EIA completed on Impala Platinum. Just a few key takeaways I'd like to leave with you following the presentation are: we have maintained our overweight recommendation. We feel that the group continues to offer value at the current levels, particularly given that there's a nice free cash flow yield of 30%, as well as a forward dividend yield of 18.7%. There are some headwinds that the group has faced, particularly in the form of the PGM prices, which have come under pressure of late. Despite this, at the current levels, the group does still remain relatively profitable. And in terms of our calculation, we have assumed much lower rates just to stress test the profitability of the group. In terms of the production guidance provided by management, they expect a 4.9% improvement. We have, however, assumed a lower production guidance in our intrinsic value calculation. And the marginal improvement is really soft in terms of what market had expected, resulting in a bit of a downfall on data release, but it's due to a base metal refinery bottleneck which the group has reported on. It may require some capital expenditure to curtail in the future, but there are some short-term wins that the group will implement to improve the refinery process there. In terms of intrinsic value, we calculate a value of roughly 246 Rand, and this is on the back, as I mentioned, very conservative assumptions. So just looking at the performance in the event, so this was a full year 21 result. The results are relatively strong and were supported by strong PGM prices, roughly 47.5 billion Rand revenue improvement on the back of PGM prices, as well as a small reversal of a previous impairment of 14.7 billion. Further, there was a 17% increase in PGM production, above 3,000 ounces, which is fantastic given that is well above what they have achieved in the previous 5 to 6 years. The group did record relatively flat exchanges, and the recent weakening in the Rand will support the investment case. In terms of the PGM dollar basket price, that increased by 59% to $2,500 per ounce. We currently estimate that moving towards closer to a 2,000 ounce at present. The group further recorded very strong cash flows. They are in a net cash position, and as such the balance sheet is nice and healthy and strong. But they also increased their dividends, which is great to see, because in the sense that management is preferring to pay out excess capital to shareholders rather than look at capital expenditure in terms of new projects. In terms of the impacts on data release, the market reacted very negative to the reaction. The share price closed 6.86% lower relative to the all share. This was probably on the back of the softer guidance going forward, as well as some lower expectations in terms of earnings relative to the market. The group has, however, underperformed the benchmark since our last recommendation in February 2020. In terms of the assessment, the group really did record strong earnings. It did, however, overshadow some of the underlying details, particularly 11% increase in the unit cost. This increased to 60 ounces to $14,000. It is worth noting that in our forecast assumptions, we've increased that to roughly about $16,000 just to be conservative. There was a 63% increase in the rise of the cost of sales. This was largely due to the increase in production. So effectively, it does cost you a little bit more to increase your production, but you get the upside benefit in terms of the 59% increase in the PGM prices. So it is a one-for-one to a large extent. The group has reported a lot of inflationary pressure, particularly in the commodity space, and as the economy starts to open up, it does seem like inflationary pressure is becoming a concern. They have also expended a bit more money on mine improvement, but that was really once-off in nature. With regards to the forward-looking production numbers, they were relatively flat and soft relative to some of their other competitors in the market, or peers in the market. We do expect marginal improvement in volumes, but then the lower full year 22 results is on the back of the low PGM prices at present. The results would appear to reflect the top of the earnings curve, and we take that as a caveat, just given that it was a perfect scenario in the sense that they had fantastically high production volumes, as well as the benefit of a higher PGM price for a large portion of their earnings period or their fiscal period. However, despite the price and cost headwinds, the share does appear to offer value at the current prices. Trading a 6% discount to its 5-year average is definitely low, as well as a small discount to its peers relative to its historical discount. In terms of intrinsic value calculation, the assumptions are included in the EIS, so please scrutinize that. What the intrinsic value we calculate is roughly 246 Rand per share. So it's one of those scenarios where we are highlighting quite a few risks and some headwinds that the group is facing and has faced. However, in spite of those headwinds, the group continues to offer value. Should you wish to place an order, please speak to either your financial advisor. Alternatively, the trading desk will be more than happy to assist. Please take note of the disclaimer and have a great day further.